Yo, what's going on, everybody? It is Wednesday, November 1st. So we had the Fed meeting today, and I was wrong about something. First, I was right that I said there would not be a rate increase, because that's very easy to predict. All you have to do is look at where Fed fund futures are trading and what the implied probability is of a change in monetary policy, because the Powell Fed just follows whatever the market says. And I've said this many, many times. So you could just save yourself a lot of worry and concern and speculation by you go to that CME FedWatch tool. If you just Google FedWatch tool, it takes you to the CME page where it shows you the implied probability of, a rate adjustment by the Fed. And actually, right now, Fed fund futures are saying no more rate hikes, and they're even starting to price in a rate cut next year around May. Now, where I was wrong was I said Powell was going to be really hawkish at the meeting, at the press conference, because I felt he was going to continue to try to discipline inflation expectations, but I was wrong. He was actually, I didn't watch the press conference, but I had some friends who told me that they watched it, and what I read online was that his tone was kind of neutral for the first time. So this is big. This is big because it's the first time since the Fed started raising interest rates in March of last year, March 2022, that we have gotten a shift in the rhetoric, in the tone. And that's what I was waiting for. That's what I think, savvy investors were waiting for. The Treasury market couldn't really rally until you got a change in the Fed's tone from these hawkish comments to now more of a neutral, maybe even slightly dovish, okay? So I think that gives a green light to the Treasury market for a rally. Now, it also does something else. It triggers the monetarist zombies to go in the opposite direction, which is now they're going to start buying stocks because they spent the last, 18 or 20 months selling on the fears of, higher interest rates. That was a disaster because the market absorbed that and went higher. And now we will get a market rally that is going to become more speculative as it goes along. But for right now, I think that things are looking pretty good. I have to say that there is something that we have to keep our eye on, and that is the possibility of a government shutdown after November 17th or on November 17th, because that's when the current continuing resolution, which keeps the government funded, that's going to expire. And we got to go through this bullshit again with Congress coming up with another continuing resolution. I don't know. As far as the fiscal flows are concerned, we ended up the month of October with a 493 or 494 billion leading spending flow. And that compares to a 445 billion leading spending flow in October of 2022. So leading flows are above last year. That's the good news. The bad news, and it's not really that bad, but the bad news is that I think we ended up with something like a 29 billion deficit. But in October 2022, there was a 71 billion deficit. So, that's like a 42 billion shortfall or year-over-year negative differential. But the good part of that is, and I track this thing on a weekly basis. I could even track it on a daily basis if I wanted to, but there's too much noise in the daily. I track it on a weekly basis. So we have now narrowed because that year over year differential was like 56 billion. It is now down to 42 billion. So it's going in the right direction. It's narrowing. And that's what I said was going to happen. Once we recover that deficit, and remember, this is important because in October, we got the restart of student loan payments. All right. So there was a chance that we were going to see a reduction in net spending, right? Because what are student loan payments? The government is taking away that money now and not necessarily, you know, spending it back out. I had to see if that deficit started to, if that differential started to widen year over year, then that would have been a bad sign. But now it's narrowing. So that's a good sign. And that's what I thought was going to happen because the leading spending flows are higher this year than they were last year. However, right now in the fourth quarter, because of the drain from those student loan payments, we're going to see economic growth slow down. As a matter of fact, the Atlanta Fed, they've already done, they came out with their first estimate of fourth quarter GDP growth, and it was like 2.3%, I think, something like that. And then now they just revised it down to like 1.2%. Okay? And a lot of people picked up on that and they're freaking out. Because remember, in the third quarter, we did almost 5%. I don't think that's a problem. I mean, I do think, or I have said, actually, I did say that we're going to see a slowdown in economic growth based on, you know, a modest reduction in the stimulus. By reduction in the stimulus, I mean, now those student loan payments are being, you know, sucked out. There's a little bit of a drain going on in the swimming pool. It's bringing the water level down a little bit. You could still go swimming. You could even dive into the pool. There's no risk that you're going to hit your head on the bottom. But the water level came down a little bit. All right. And I think it's going to stabilize because there's still enough in terms of interest income transfers to the economy that, you know, the water level is going to stabilize. It might even go, and I think it's going to go completely back up to where it was. So I think the slowdown in fourth quarter GDP growth is going to end up being a one-time thing. I do not see a recession. I see a slowdown in growth in the fourth quarter compared to the growth rate we had in the third quarter. No big deal. I mean, we basically been going for 30, 35 years in the U.S. with like a 2.5% to 3% growth rate. So, I mean, we're right back there again. And that's been fine for the stock market, number one. Also, that should bring inflation down, which the Fed is going to react to and the monetarist zombies are going to react to. So it's kind of like, I guess you would call it kind of like a Goldilocks scenario. Not too hot, not too cold. The only thing we got to worry about, like I said, was, and I'm not so sure it's necessarily a big worry, but, you know, there's always that possibility. When you're talking about Congress, there's always that possibility. And again, that is the continuing resolution that expires on November 17th. So, I mean, I think you got to paint it as good news today. We finally got Powell, finally, you know, this was the pivot. Remember, we heard that so many times earlier this year, like, when is he going to pivot? When is he going to pivot? When is Powell going to pivot? And I said, I was saying he's not going to pivot. And it's like a sickness, this monetarism. It's really like a mental illness because, you know, they're so glued to every single thing, every single word, like interest rates really mean that much, and they don't. Again, I've said it a million times, interest rates are, their price changes and their fiscal adjustments. Rate hikes equate to higher fiscal transfers. Rate cuts equate to lower fiscal transfers. And the rate itself is a price. All right, and it basically sets the price of all other prices because, like I said a million zillion times, the cost of credit is reflected in the cost of all goods and services. I don't get all crazy about this stuff, because I understand what it is. And this whole monetarism psychosis is just so blown out of proportion that it's a mental illness. That's what it is. It's a mental illness. To see these people like jumping in and out and this way and that way, and what's he saying and what does that word mean, and when is he going to pivot and not pivot, and 25 basis points and not I mean, you're dealing with stuff here that is so ridiculous and so irrelevant. If you have understanding and you understand like it's a price change, if you go to your store and something changes in price, you could continue purchasing that item or that service. You could look for an alternative. You could not, purchase it anymore. I mean, but the price is what's paid and what is received by somebody. That's what it is. So basically, any adjustment in the price is just an adjustment of who pays and who gets paid what. There's no reason to blow it up, beyond anything that what it really is. So I don't follow it. I just don't follow it. To me, it's really unimportant. Like I said yesterday, I understand that it triggers behavior in people because this is, monetarism is so baked into behavioral finance, behavioral economics, just the behavior of investors, that I understand how they're going to react to it, which is fine. Let them react. But their understanding of it is really, really, it's shallow, it's flawed. What else can I say? And we had another guy, because these last few days I've been talking about these guys like Ray Dalio and Drunken Miller and Paul Tudor Jones. And a friend of mine emailed me, because I don't watch any of these business shows, these financial shows. I just think they're a joke. And I've said it before. If you watch CNBC or Fox Business, basically, I think, you're just becoming stupid by watching these things. But anyway, a friend of mine sent me an email saying that it was Jeffrey Gundlach today, talking about how the interest rate is unsustainable for the government. Why? Is the funding of defense and wars in the tune of trillions and trillions unsustainable? There's never any question about that. How is it unsustainable? This guy's supposed to be the bond king. And then he was going on talking about the debt, as they all do. The debt, the debt, the debt. There's no debt. Government pays for things. That ends up as reserve balances in the banking system. People and institutions decide to hold those reserve balances as government securities because they earn more interest. Again, it's just like moving your money from your checking account to your savings account. How do you pay it back? That's always the question. There's really nothing to pay back. When the securities mature, the Fed just debits the securities account and credits your bank's reserve account, and then your bank credits your checking account. It's like when you move your money back from your savings account to your checking account. There's no paying back at that point. It's just like, it's like a bookkeeping entry. Everything's been paid for. I don't understand this paying back. I mean, it is so, and I can't believe we're still here having to listen to this about paying back. The government spends, the money is paid to somebody or some firm. It ends up in a bank account. That money is used to buy some treasuries because it earns a higher interest. When the treasuries mature, the bank account gets credited with cash again. The treasuries get debited. That's it. It's just a bookkeeping entry. There's nothing to pay back. Everything's been paid for. And all of that, what they term as debt, that, you know, whatever it is, 33 trillion, that's 33 trillion of assets, financial assets that are held by the non-government. I mean, you want to take that away? Is there any reason to take that away? Unless you want to cause, you know, a global depression on the order of magnitude that we have never seen before in history. Try to take it away. For what reason? It's crazy. Anyway. All right, that's it for today, folks. Today was today is November 1st, so it's the first of the month payments day. That's a big leading flow of about 95 billion, net flow of about 65 billion. We'll see the numbers tomorrow. We'll also get an indication of investor sentiment, because tonight the AAII weekly sentiment survey comes out. If you want to see my breakdown and analysis of that, go to my website right now, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. I send that out early in the morning tomorrow. See everybody. Bye.